Hello, it's Mathew Cassidy, Managing Director, and welcome to the March Investment Update. What I'd like to cover off today is three key themes, looking at the global macro issues, obviously issues impacting markets and how we see economically things will play out for the balance of this year. We'll also take a look at international markets, what we've seen occurring over the last month, and then what we're sort of seeing as further good news in the Australian market. Had a very interesting lunch during the week, and that was with the head of investment strategy with Macquarie Private Bank. And one of the things we were talking about was, are we going to see for the balance of this year any major market disruption? Could that be an inflation adjusted issue, or could it be an earnings issue? Both of which, if we saw playing out, would be a major market correction. We're both of the view that leading into the balance of this year, neither of those particular issues will play out, which could be a little contrary to some of the recent market commentary talking about a rise in bond yields. A rise in bond yields can be certainly problematic for markets in the event that we start to see the cost of capital getting more expensive and therefore starting to reduce corporate profits. And at any point in time, we also see bond yields rising. It can certainly create some volatility to asset prices. However, we certainly don't see that will actually play out for the year. And why is that? Well, principally, during the month, a really good article came out by Nicholas Moore, the former CEO of Macquarie, commenting that traditionally when we see large periods of inflation, we see labour markets at full employment. And what we're actually seeing at the current point in time is an economic recovery not necessarily led by extreme levels of growth in wages or employment. And certainly employment's increasing, however, it's certainly not at the stage of causing any major issues. So as we look to the balance of the year with some unbelievable and almost unprecedented support behind the economy and investment markets by governments around the world, they are simply continuing to do what they need to do to get the economies back up and running. As we stand at the end of March, we still see that the levels of support is continue to increase, more buying of assets within the economy. We don't necessarily see though that they're just simply dropping money into the economy. They're effectively buying up assets to shore up investment markets. A real key difference between a simple measure that could spike inflation versus the support of the economy. Internationally, we've also seen the Biden government talking about a huge infrastructure and investment spend. Again, measures to simply get this economic recovery occurring and accelerating. And what's actually been interesting to note as we've all, meeting with clients at the moment, reflecting upon their returns for the last 9 months, we've actually seen some really solid returns for this last 9 months while we're actually still in a period of recovery. It is natural at these periods to start to see economists and market commentators talking about the fact we could see some really high levels of inflation because asset prices have actually recovered at a more accelerated level. However, we don't feel that those asset prices will run away, to an extreme level and actually cause some issues. What we have seen occurring over the last month is some of the assets that performed extremely well at the back end of sort of 2020 and into early 2021. A lot of the technology stocks have probably taken a bit of a pause and some have actually pulled back. And again, as we discussed last month, there's been more of this cyclical trend to more industrial and some old world names. This is natural that it occurs. I think any portfolio should be well aware of having that level of diversification as we constantly do, and making sure we're not taking any big bets or allocations to any assets in any one particular sector. And that's been really important over this last month. On a domestic front, we are still seeing some quite unprecedented levels of support in the economy. We have seen the end of JobKeeper and certainly some commentary that'll potentially increase unemployment over the short term. But when we think about the level of interest rates, the extreme performance of the housing market, I think in the 25 years of my experience in investment markets, I don't think we've quite seen a period of growth in the property market or the level of property clearance rates. But also the level of tax cuts, the level of household spending, the $60 billion we're not spending going overseas, it's all just sitting in bank accounts waiting for for people to spend. In fact, when speaking to the head of strategy at the private bank during the week, his view, and I'd probably taper this a little bit, was that he'll see that the ASX 200 will be 15% higher by the end of the year. That's certainly a very optimistic view, but one I think shared by a number of people within the market. So what do we need to look towards to ensure we're getting ready for this future optimism? I think it's a case that we will see periods of volatility. We are not sitting back as a business trying to pick the bottom of the market, but simply trying to find where the opportunities are, where the asset prices are, and making sure we're buying when things are fairly priced. Hopefully that's been a reasonable update. Again, we look forward to keeping everybody updated as we progress during the year, but certainly hoping 2021 can be a year whereby, again, we'll further put the events of 2020 behind us and certainly focus on some real prosperity in asset markets. Thank you very much.